If you have clicked on this video, that means you have never invested a single penny in your life. You've got a few $100s left at the end of each month. Maybe $200, maybe $400 if it's a good month. And everyone is telling you a different story about what to do with it. And somewhere in the noise, you're supposed to turn a few $100s into a future. I get it, not everyone can track the financial charts, read annual reports, and understand financial securities. But this video is the only guide you will need in 2026 to invest smartly. What if I told you that investing just $300 a month could turn into $400,000 to $500,000 in the future? Look, I know you're working, paying bills, doing your thing, and whatever you manage to save just sits in your savings account, which is good. At least you're saving. Most people don't even do that, and our financial ecosystem is designed to keep us broke. But keeping everything in a savings account, which only pays between 3 and 5% return, is not the smartest move. Inflation is the real thing, and it's quietly eating that money. If you want to check how real the inflation is, get hold of the last 12 months of boxes of your favorite cereal or coffee and watch the prices rise. Increasing price for the same quantity of coffee, your cooking oil, and your milk. That's inflation. And every time some guy comes out and changes tariffs, the prices of our daily supplies change, be it food, automobiles, or even your phone. This world runs on supply chain. It's all about trade. So even a slight distortion can change the prices of your daily needs. So forever growing the money in a savings account is not the right thing to do. And before we talk about investing and all that fancy stuff, there is this famous quote I relate with. It says, "Staying positive does not mean that things will turn out okay. Rather, it is knowing that you will be okay no matter how things turn out." So, before investing a single dollar, tell me this. What happens to your finances if this happens to you? That's why you need an emergency fund. Nothing sexy. Just 6 months of expenses in a high-yield savings account. This money is for your
inner peace. Dinner, please. Dinner with peas. Snow peas?
If you don't have this yet, honestly, put your full $300 a month here first. And if you've got credit card debt or some loan charging like a 15 to 20% interest rate, man, forget investing for a second. Kill that first, because there's no point trying to earn 10 to 12% in the market while losing 18% to interest. You need to get rid of that weight. All right, once that safety net is done, now we can talk about growing your money. I have divided the allocation strategies into 3 groups: conservative beginner, balanced beginner, and growth-focused beginner. Multiple factors in each group determine what percentage of your savings should be invested in a particular plan. Let's start with conservative beginners. This one's for people who say, if my money drops a lot, I know I'll lose sleep. If you are someone who constantly tracks the portfolio and gets panicked when numbers turn red. If you have an unstable income and no one to help you out if you're in distress. This portfolio is for you. Here, the goal is to protect your capital and grow it slowly. Let's take an example. You can save up to $300 per month. You can invest 40% in broad market index funds like the S&P 500 or the Nifty 500. It depends on which country you live in, but generally broad market index funds are safe and easy. Here, you will own small pieces of hundreds of big companies at once. Historically, it beats most expert stock pickers over time. It's simple, cheap, and proven for building wealth slowly. You can invest 20% in global or international ETFs. This is your reminder that the world is not run by one country. By investing globally, you are less prone to the economic uncertainties of one country. Think about it. If your country's economy slows down, others might speed up. So instead of keeping eggs in one country's basket, expand the basket. Next, you can invest 20% in bonds or debt funds. Now, if you don't know what bonds or debt funds are, don't worry. I am always there. Think of a bond as lending your money to someone. That someone could be a government entity or a big company. Now that someone says, give me your money for a few years, I'll pay you interest every year, and at the end, I'll give your money back. Let's understand this with an example. You buy a $1,000 bond paying 5% interest per year for 5 years. Every year, you get $50 as your return, and after the completion of 5 years, you get your $1,000 back. So when you buy a bond, you are the lender, the company or government is the borrower, and the interest they pay you is your return. That's it. There is no ownership of any company, no guessing winners in the market. It's just plain old lending and getting paid. And debt funds are just a collection of many bonds packed into one fund. Next, you can invest 10% in gold. Gold, as you all know, has been historically looked at as crisis insurance. Gold doesn't grow like businesses. It doesn't produce anything. But when currencies wobble and geopolitical stress rises, gold tends to be remembered. Gold is so important that I can do a complete video on the importance of gold in the financial market. Subscribe if you want that video. Coming to the last 10%, you can invest that amount in liquid funds. Liquid funds are low-risk debt mutual funds that invest in highly liquid, short-term money market instruments like treasury bills, commercial paper, and certificates of deposit, which mature within 91 days. It acts as an excellent parking spot for idle cash, offering better returns than savings accounts with easy redemption, often within 24 hours. They provide high liquidity and low volatility, making them ideal for emergency funds or for short-term goals. This fund acts as a flexible alternative to bank fixed deposits. So basically, this portfolio won't make headlines, but it will make a good return of almost 9 to 12%. It won't double your money in 2 to 3 years, but it does something more important. It keeps beginners invested long enough for investing to work. If you invest $300 monthly at 10% by the end of the first year, it will become $3,792, which will turn into $7,964 in the second year. And if you stay consistent and you do that over a long period of time, you are already beating most people. Now, let's talk about our second category of people, the balanced beginner. This is where most people should land, not because it's perfect, but because it balances ambition with reality. Let's understand who this is for. This plan fits for long-term thinkers with stable income and a moderate risk tolerance. In other words, for people who understand that wealth is built slowly, but they don't want their returns to crawl. Let's discuss the allocation. You can invest 45% in broad market index funds. No matter how fancy portfolios get, this remains the foundation. You can invest 15% in AI and tech ETFs. This is your tilt toward the future. Just by looking at the news, we all know AI is a major long-term growth trend with applications in healthcare, finance, manufacturing, and transportation. AI could contribute trillions of dollars to the global economy by 2030. Investing in AI ETFs offers diversification and reduced risk. An AI ETF holds a range of AI-related stocks across industries and locations. This approach spreads risk as the underperformance of some companies is less likely to affect the entire portfolio. I believe technology will keep reshaping the world, but I won't pretend I know who wins. So it's a bet on direction, not prediction. You can invest 15% in emerging market ETFs of countries like India, Canada, Australia. This is your demographic bet. Emerging economies often experience faster GDP expansion than developed markets due to factors like industrialization, urbanization, increasing consumer demand, and younger populations. This can translate into significant long-term capital appreciation for investors. Next, you can invest 10% in gold. I understand it's boring, but it's very important. You can either buy physical gold or invest in gold bonds. Again, you can invest 10% in government or corporate bonds or debt funds. Finally, you can invest 5% in digital assets. You can choose anything between Bitcoin, Ethereum, or any major assets only. Don't invest in meme coin, no NFTs, and definitely no trading. This portfolio has strong long-term compounding potential and is emotionally manageable for most people. This is the portfolio that will make a good return of almost 12 to 16%. It doesn't look dramatic, but quietly does the job year after year. And it's how many real-world investors build wealth without anyone noticing. Now for the Red Bull drinkers of growth-focused beginner, embrace the ride. This portfolio is not gentle. It's built for people who understand one thing: big returns come with big discomfort. This fits for people with a high, stable income, strong emotional control, and people who won't panic sell. If a significant drop will make you quit, this portfolio will hurt you. This portfolio will test you. The goal here is to maximize long-term upside. Let's start with the allocation and why it still isn't reckless. You can invest 40% broad market index funds. Even here, this never disappears. You wonder why? Because no matter how aggressive you are, you never skip the system. You can invest 20% in AI, tech, and innovation, ETFs. This is your high-growth engine. This sector will swing hard, but revolutions usually do. You can invest 15% in emerging markets. If you are comfortable, you can invest 10% in digital assets again, only major assets, no leverage, no memes. Next, you can invest 10% in gold and silver. Don't forget it's your anchor and your savior in difficult times. Finally, you can invest 5% in keeping cash to buy dips during crashes. If you follow this investment plan, you're likely to make anywhere from 15 to 20% annually, which in a period of 10 years will actually double your investment amount. And like I said at the start of the video, a constant monthly investment of $300 will make you over $500,000 in 20 years. And if you keep going till 30 years, it will make you over $1.5 million. Now that, my friend, is the power of compounding and consistency. The real difference between these portfolios, it's not returns. It's how much pain you can tolerate without quitting. Because mathematically, all three can work. All three can compound. All three beat doing nothing. But psychologically, only one will fit you. And the best portfolio isn't the one with the highest expected return. It's the one you'll still own 10 years from now. So, choose wisely. If you like this video, subscribe to the channel and comment down your thoughts about this video.